Hey, John Strohmeyer with Strohmeyer Law. This time, we're talking about things you should be looking at when you're reviewing your 2020 tax return. Now, there are a lot of things that go into every annual tax return or your IRS Form 1040. I can't cover everything, but this is going to be a list of things you should be checking on a regular basis. Now, at the end of this, I'm going to talk about a number of things that everybody should be checking every year. I'm also going to be coming up with my list of things you should be looking that are specific to filing for 2020. So let's start at the top. Things to look at. Well, are you taking the standard deduction? So that's going to be $12,400 for a single person or $24,800 for a married couple that is filing jointly. So this is going to be on line 12 of your Form 1040. Now, if you made cash contributions to certain qualifying charities and you are taking the standard deduction, well, guess what? You don't have to worry about those cash contributions to the charities as much because you're going to be allowed to deduct up to $300 for that on line 10B. So what this means, before you were only able to take those deductions if you were an itemizer. Now in the future, what this could mean is if you're going to be making regular deductions and you're actually an itemizing taxpayer instead of taking the standard deduction, what you want to look at is, do you want to bunch those deductions into certain years? So rather than making ratable deductions that may not give you much of a benefit in any one tax year, maybe you'll say make a larger donation for the next 2 or 3 years in 2021. You're not going to make a deduction in 2022 or 2023, but you'll come back in 2024 to make another 3-year gift so that you are able to take a bigger tax deduction because it's enough to push you over and really make a difference on your income taxes. Another thing you want to be checking every year, what is your filing status? Are you still filing under the correct status? Things that can change. You know, if you are married now, but you are not married when you file, then you need to think about whether it makes sense for you to be filing under a different tax status. So typically, once we get married, we're filing under the married filing jointly return. This is a bonus. You have to elect into this status. What we want it and why we're doing it is there are incentives and tax bonuses for you to do this. But if the marriage ends either because of a death or divorce, then you're probably going to be changing your status. Now, it is important to know you've got to qualify for these certain statuses, and you want to make sure that you're claiming the correct status. One of the ones that can and does confuse people is the head of household. This has some very technical requirements. You've got to be single with dependents in the household. It doesn't, again, automatically come to you. You've got to make sure that you are actually qualifying for it. Moving on to actual reporting issues, we want to think about what happens when we're reporting investment income. Now, if you've just got the one job, you'll have a W-2 to report your income. You're going to see that show up as part of gross income. But what you also want to make sure is if you've got interest income or if you're that it's getting reported correctly. So interest income gets reported on 1040 lines 2A and 2B. Dividend income gets reported on lines 3A and 3B. Make sure that if you're reporting there, Schedule B accounts for this extra income. And you want to make sure if the interest and the dividends are taxable or tax exempt, make sure that they're getting reported correctly. If it's tax exempt, we don't want to pay tax on it. So make sure it's getting slotted into the right lines there. Now, on the other side, if your earned income for a year, so wages or other earnings from self-employment are over $200,000 if you're single, or $250,000 if you're married filing jointly, you may be subject to the additional Medicare tax of 0.9%. So again, this is something where you're unfortunately checking to make sure you're paying enough tax. But again, your obligation is to make sure enough tax goes in. This is something to double check. One other thing to think about with our divorced taxpayers. A few years ago, they changed the law. Any divorce agreements entered into before January 1, 2019 still allowed for alimony to be deductible by the payor and includable as taxable income by the recipient. Changed the law. Any divorce agreements that are in place and entered into final status after January 1, 2019 we don't have that option anymore. So if you entered into a divorce agreement before January 1, 2019, then that's going to allow you to have the ability to shift taxable income between the two spouses. Once we get into 2019 and later, really everybody's responsible on a going forward basis for their own taxable income. Looking into something to think about for 2020, we did have the economic income payments from last year. Not everybody took the full payments. If you ended up not taking that full payment, make sure that you are looking into, can you claim the recovery rebate credit? If you can, make sure you're doing that. Don't leave that on the table. When we start thinking about some of our income, some of the best planning options we have are using the retirement accounts. So beyond making contributions to your IRAs, Roth IRAs, 401ks and such, we want to know what else can we do. So here are some things to think about. One, are you making contributions to your IRA? Well, if you are, the total contribution limit for 2020 is $6,000, gets bumped up to $7,000 if you're age 50 or older. Are you making a contribution to a Roth IRA? Well, if so, your contributions aren't going to be reported specifically on your 1040 unless you're taking advantage of some sort of retirement savings contributions credit. The total contribution limit for 2020 is also going to be $6,000, $7,000 if you're above age 50. Again, there are options for picking which of those is the better retirement vehicle for you in your tax reporting. Additionally, thinking about, well, for your IRAs, did you make non-deductible traditional IRA contributions? So just because you can put money in and it's deductible doesn't mean you can't keep going and make non-deductible contributions. So if you are doing this, you're going to trigger a reporting on Form 8606, and you'll want to make sure that you're tracking the cost basis for your assets there. Other random issues to think about: if you're making contributions to HSAs, or if your employer is making contributions on your behalf, you're going to get Form 8889. This, I do like HSAs. Why? It's tax deductible income. It's disengaged from the IRA, 401k planning. I do like these because they are a separate matter where you can still deduct income and have it be left for your benefit. Obviously, you're limited in what you can use because it's in an HSA, and you have to have an account that will qualify you for an HSA. But this is a way for you to take another $3,550 if you're on a single plan, or $7,100 if you're on a family plan. Take that off of your taxable income. If you're over age 55 or age 55 and above, there's $1,000 a year catch up. So again, you're allowed to put money into these HSA accounts. And to the extent you don't use it, you're allowed to, generally, once you get about $3,000 or so, it varies account to account, you can start investing it so you can actually grow your money in a tax-advantaged account. Something to think about with other specialized accounts: 529 education savings accounts. If you took a non-qualified distribution from one of those 529 accounts, you're going to need to file IRS Form 5329 to calculate the penalty on those. Penalty is carried over to other parts of the return. Obviously, the better plan is to avoid taking those distributions from the 529 that aren't qualified, but if it does happen, these are your options. Something else: rental real estate. This is something on an annual basis. These are always going to generate more compliance costs for you, but because you're earning income, you want to make sure that everything's getting reported, and you're also reviewing specifically Schedule E to see expenses that may have been deductible there. Finally, student loan payments. Make sure the interest is being deducted on Schedule 1, line 20. Again, that's a deduction you've got. You want to make sure that you're taking it. So that's a good wrap up of some general issues. Some things you want to think about every year. One, making sure that your filing status is correct. This is something that can be overlooked. It may change just in the with everything going on. while it doesn't generally change, you always want to make sure that you're still in the best status available for you. Number two, always want to think about, are there any assets that you own that are held outside the US? The IRS spends a lot of time cleaning up and going after taxpayers who have assets abroad, who receive compensation from abroad, who are not properly reporting it. Remember that as a US taxpayer, you're responsible for reporting and paying income tax on your worldwide income loss deductions and credits. So if you own assets abroad, it's going to come under that umbrella of you need to make sure that you're reporting all of that to the IRS. So it's not just a 1040. You're probably going to have some filings like the foreign bank account report. Dog interlude. So remember, when you own assets abroad, there's more than likely going to be a form that you need to fill out to report what you own. Turning to things that are new this year, we're going to start with looking at a new question on Form 1040. Now, if we take a look over here, IRS 1040, something that's new, this line on virtual currency. Now, at any time during 2020, did you sell, receive, send, exchange, or otherwise acquire any financial interest in any virtual currency? Checking yes or no. Now, the IRS is being very broad on here. There are a few exceptions for getting out of this reporting requirement, but basically, if you bought any virtual currency, cryptocurrency, Bitcoin, Ethereum, Litecoin, Dogecoin, whatever it is, if you exchanged your fiat dollars for Bitcoin or something else, then you're going to be checking yes. Look at that. The reason we want to do this, we want to make sure that we're telling the IRS. They do have a lot of initiatives right now to make sure that people are reporting exactly what they own and not trying to get around paying income tax that they may have. Now, back in 2014, we got our initial guidance from the IRS on Bitcoin. That has not changed. Taxation of Bitcoin, there are some things that are unclear, but ultimately, once you receive that, you're going to be treating it as though it were property. It is not treated as currency. Remember, if you receive Bitcoin in some sort of transaction, you're almost certainly going to be paying income tax on that. So if you have mined Bitcoin, then the receipt of that in exchange for your mining operations is taxable income to you. If somebody pays you in Bitcoin, then that is going to be taxable income to you. It is, frankly, no different than somebody paying you in stock, or if you have gone out and dug up a gold nugget. The Bitcoin does not escape taxation. You are still responsible for paying your income tax on it. Other things to think about. So we talked about some of the changes for 2020 and 2021. First thing we want to think about is the enlarged universal charitable contribution deduction. Normally, charitable contributions are only deductible if you are itemizing your personal deductions on Schedule A instead of taking that standard deduction. Now, in the past, we had taxpayers, of 100% of everybody who filed taxes, roughly 30% were itemizing. Because of changes and increases in the standard deduction, really only 10% are are itemizing instead of taking the standard deduction. Well, that means that most of us, 90% of us, aren't able to deduct any charitable contributions. So the change that came was part of the Coronavirus Aid, Relief, Economic Security Act, or the CARES Act, is trying to pull this back, allow those of us who do take the standard deduction to still get some tax benefit from our charitable contributions. So there is a $300 universal above the line charitable deduction for cash contributions by non-itemizers to tax qualified charities in 2020. So this is also the same amount. Unfortunately, if you're married filing jointly, or if you're a single person, you only get one $300 credit. This doesn't really upset the, should you remain married or not, can't tell you that. But for a $300 deduction, it probably makes sense to keep things where they are. But as a change to that, the Taxpayer Certainty and Disaster Tax Relief Act of 2020 extended the deduction to 2021 and repeals that marriage penalty. So the deduction will be $600 for married non-itemizers filing jointly, but right now it's just for 2021 only. Another thing to think about is the CARES Act eliminated the AGI limit on charitable contributions. Now, going into the calculation of the charitable deductions amount is very complicated. I could spend an entire day talking about how you actually calculate it. But the Tax Certainty and Disaster Relief Act of 2021 extended the 100% AGI charitable deduction to 2021. So it's rarely, one of the things you want to think about is rarely are you going to say, you know what, I'm going to take my entire adjusted gross income and donate 100% of it. That's probably not the best tax planning strategy, but know that it at least is on the table for you. Another thing to think about, President Trump had extended a voluntary payroll tax deferral repayment period. Not a lot of employers took advantage of this. All it did was basically say, if you want to defer making payments for payroll tax purposes until 2021, you can. A lot of employers, me included, said, I don't want to upset how I do things. This would mean changing my payroll tax practices. I'd rather make sure that I'm complying now. Well, what they were trying to do was increase employee take-home pay during those months last year, so that the 6.2% up to $137,700 for wages during 2022, that wasn't going into the IRS. Compliance with this was voluntary, and as I mentioned, few private employers took advantage of this, but it was mandatory for some federal and military employees. Well, COVID-related Tax Relief Act of 2020 allows employees who had their taxes deferred, they can defer paying those back until December 31, 2021, instead of by April 30th, but those payments should be made ratably during the period. This ultimately gives employees a bit more take-home pay during January through April, but it's obviously requiring you to repay and lower your pay throughout the rest of the year. When it comes to medical expense deductions, we've got something that people are always wondering, can I deduct what I spend on my medical costs? This has fluctuated between 7.5% and 10% of your AGI. So meaning you've got to figure out your adjusted gross income, and then 7.5% to 10% of that is your floor before those deductions or those medical expenses become deductible as a personal itemized deduction. So really, you've got to spend quite a bit of your income as a percentage of your adjusted gross income before you can start deducting those medical costs. It usually comes as a bit of a surprise to folks that it's not just $1 is deductible. Really, you've got to get to a certain percentage of your AGI, and then that's the floor. That's once you get past that, that's when you can start deducting it. Well, it's now 7.5% for 2020, and before the new law, it was going to go up to 10% for 2021 and later. Well, the Taxpayer Certainty and Disaster Tax Relief Act of 2020 makes this 7.5% a permanent floor for your AGI. So it's a bit easier to qualify. The downside is you're having to spend a lot of money on your medical expenses before you can get to it. So as we look to wrap this up, there are a lot of things in there. There's no way I could go through all of them, but if you are making cash contributions to charity, you can still deduct those payments even if you don't itemize. You could deduct up to 100% of your AGI as a charitable deduction, whether or not that makes good financial sense for you. You're allowed to lengthen the time that you can repay your 2020 Social Security taxes if you had them deferred. And your medical expenses, now you just need to hit 7.5% of your adjusted gross income in 2021 to deduct those. So a lot going on. Make sure you talk to your taxpayer, but I hope this has been helpful to get you a few more tax dollars that stay in your pocket.